Hello, I'm Chris Pedersen and this is Stock Watch on Wednesday the 17th of January 2024. All advice is general advice and might not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Some of my market observations this week. First off, the Australian 10-year bond yield is creeping up again. This morning it was at 4.22%, and on the 28th of December it was down at 3.91%. So this is a pretty big move. This rise will dampen equity market movements upwards. WTI, which stands for West Texas Intermediate Crude oil, is at $72 a barrel. This has been staying low throughout the Red Sea crisis. Now, all the market pundits have been expecting oil to soar because of attacks on oil tankers. So far, that's not really happening, and the reason is all these ships are generally getting through just fine. The press is making a bigger deal out of what's happening than it really is. The U.S. and other allies have attacked to try to stop it. Yes, there'll be a few more, but believe me, this is too important to allow the terrorists to continue attacking the ships. Tesla and other automakers have surprisingly raised employer pay. Why have they done this? That's because the United Auto Workers Union is getting stronger, and they were successful in strikes against Ford General Motors. They are afraid of the union getting into their factories in America, so they're trying to head them off at the pass by giving everybody a raise now. Geez, doesn't that kind of justify the purpose of a union, to make sure people are paid right? And doesn't that mean Tesla wasn't paying a fair wage earlier? But anyway, they've done what they've done. It might be successful, or the union still might be able to get into their factories. The U.S. election cycle has kicked off. My advice on this is be wary of all the misinformation that's being put out there simply for political purposes. I have been involved in politics for a long time. I see the inside. The misinformation is incredible. It is dangerous. And we will see this now for the next year in the United States. Acquisition of wealth stocks, meaning money managers, stockbrokers, well, there's a reweighting happening upwards because of some recent acquisitions. So this is good for people who own them. But be careful, it might not last. Here's a list that I wanted to share with you that I got from Morningstar. These are bond funds in Australia that have attractive interest rates. It's worth taking a look at. These are country recommendations that are from Citibank. This is also worth taking a look at if you want to diversify outside of Australia. This is also Citibank. These are indexes from across the world. This is what the expectations are. Now, unfortunately, you look at the ASX 200, Citibank expects us to be flat this year. Personally, I'm bullish on the local market. We have a lot of good companies, and our economy is growing well. So all that growth in our economy has got to be going into some company's bank account, flowing down to the bottom line. And some of these public companies are very well managed. They know how to grab market share, so I'm sure the ASX 200, if we don't go into a recession, is going to be performing just fine. Now, this is interesting. It's a little too small for me to go through it in detail with you, but you can look at it on your own. This is various sectors, and they're weighting in the global universe of listed securities. And this is very interesting. This is consumer lending. This is the U.S. market, but it applies to Australia also. That when banks start restricting lending to consumers, it often coincides with a recession. Doesn't always, but there's a good linkage that's worth keeping track of. Now, the three companies I wanted to cover today are all in the Australian tech sector. The first company I want to cover is WiseTech Global. On the ASX, the code is WTC, and last night it closed at $71.91. This is a long-term chart. It's 5 years. You look at it, and it's got a long bull run. However, it pulled back last year, but it's now regaining its upward momentum. It still hasn't passed the previous peak, so there will be technical resistance. But let's look at the fundamentals to WiseTech. I like the company because it's growing well, is in a good sector. However, let's look at the numbers. First off, these are UBS estimates, and WiseTech Global has a market cap of $24 billion. 12-month price target they have is $79.50. So that's a decent move from current price, but it's not outstanding. The revenue growth they have from 2023 to 2026 is around 25% per annum. That's extraordinary. The earnings growth in the same period is 29% per annum. That's amazing. The dividend growth is also above 20%. It's at 23% per annum. Everything is amazing. This company is a buy. However, the PE on 2025 earnings per share estimate of 98.5 cents is a huge 73 times. The yield on the 2025 dividend estimate of 19.6 cents is only 0.3%. And free cash flow, it's only 1.5% averaged over each of the next 3 years. And the payout ratio is just under 20%, which is common with technology companies. They like to retain earnings to pay for growth. WiseTech Global is a provider of software solutions to the logistics industry globally. They have approximately 18,000 customers in 17 different countries. I rate it neutral. The reason is the price is too high. A PE multiple of 73 times and a growth rate of 25 times is, well, just a little expensive. I know going way back to the 1980s, 1990s, when you had these companies, Microsoft, Oracle, they were growing huge leaps and bounds. And their PE was 50 times. The market felt, a lot of institutional investors felt, they're overpriced. But these companies kept growing. In fact, Microsoft is still growing. Even with a high PE, you can make a lot of money. However, you do have to be careful. This is at 73 times. Because it has such good, strong growth prospects, I would definitely buy WiseTech Global if it had a pullback. Next company is Zipco Limited. Code on the ASX is ZIP. It's trading at 53.5 cents. Looking at this chart, well, I don't really need to go into much more. That this has had a big rise, a big collapse, and now it's flatlining. Yes, at some point in time, this company might start rising again. From a technical perspective, you could say it's in a phase 3 cycle where it's just waiting for when it's going to go up. You buy it now, you might be waiting another 5 years before it starts to go up. This company, I would wait until it starts improving and the price starts to go up, and then look at the numbers again. Currently, it has a market cap of $500 million. UBS has a 12-month price target of 36 cents, and it's trading at 53 cents, so that's a big problem. Revenue growth rate for 2023 to 2026 is estimated at 13% per annum. That's not so good for a technology company. Earnings per share, well, this year, negative 31 cents, the year just passed. 2025, it's estimated they will improve to be a 1 cent per share profit. Companies that aren't making a profit doesn't work for me. I need them to be making a profit. Put it this way, we're a capitalist society. If a company doesn't make a profit long term, they're never going to have a price increase unless they get lucky and sell their business at a nice price. But I would not bet the farm on that. The dividend growth rate, it pays no dividend, so there's no dividend growth. This company needs to start improving before I even consider investing. The PE on the 2025 earnings per share estimate of negative 5 cents, well, forget it. You can't have a PE on negative earnings. No dividend yield, free cash flow. Well, the free cash flow is terrible right now. It's negative. However, UBS estimates that by 2025, it'll be 10%. That's good. But let's wait till we get closer to that period of time. Payout ratio, obviously, they don't pay dividends. So what does this company do? They offer point-of-sale credit and payments to customers and merchants of retail finance solutions to online and in-store purchases. Like all tech companies, they're going to be volatile, high beta, a lot of risk. You got to have a company making money to justify taking the risk. Watch it until it improves. Last company today is Altium, ALU. It has a market cap of $6 billion. 12-month price target, UBS has is $40.60. Well, that's not good because that's $5 below where it's trading now. Revenue growth rate, 2023 to 2026, is around 17% per annum. And the earnings per share growth in this period is 21% per annum, and they estimate dividend growth is 22% per annum. PE on the 2025 earnings estimate of 75 cents is 61 times. Well, they don't have a high enough growth rate for earnings, revenue, and dividend to justify a PE that big. The yield on the 2025 dividend estimate of 83 cents is 1.8%. So they're not even enticing you to buy it with a dividend. Free cash flow is only 3%. I'm better off with money in the bank. I can earn more than 3%. Payout ratio, 78%. They're paying everything out in dividend, and they're only got a 1.8% yield. Why buy this right now? ALU is a global software company that develops and sells software for the design of electronic products. My view is it has a high PE for its growth rate. This is definitely not a buy at this price. If the PE shrinks some and the growth rates improve, maybe it's a buy, but right now it's not. It reminds me of a story of Apple Computer. For a long time I watched Apple Computer, and around 2012, 2013, I took a look at it again and I go, for the first time in my life, Apple had a PE that's like 13 or 14 times. And this is after Steve Jobs died. The market was a little worried about Apple's future, and so that's why it had a lower PE. But it did have good growth rates. The analysts still felt Apple had a good core business. Well, lo and behold, Warren Buffett swooped in and bought billions. And we know the stories. Since then, Apple has just soared to new highs. Unbelievable. So with these tech companies, even though they're not attractive today, keep an eye on them. They can become attractive in the future. As always, if you want to learn more about anything I covered today, send an email request to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. I hope you have a good week and it's profitable. Thank you for your time.